Hey, good morning, everyone. Denzel here, your personal finance geek. How you doing? Happy New Year. How's it going? Let me know who's in the house. Comment below. Hello to modeling, hidden. How you doing? Brogada? Did I say it right? Good morning. Got a first, what is this, testimonial I see so far? Let's see. I started Velocity Banking in November with a $35,000 personal line of credit, and I use credit cards for daily expenses and try to pay them off bi-weekly. What's the best way to use credit card and a line of credit simultaneously? I'm gonna have a scenario on the board here, so I think I might go over that today. Should I set up my credit cards for an automatic payment to pay the statement balance directly to my line of credit? Should I set up my credit card for an automatic payment to pay the statement balance directly to my line of credit or directly from the line of credit? All right, so let's correct that. Because if I have a credit card, well, I just jumped right into it. I didn't even do any announcements or anything. We're going right into it, guys. So if I have a credit card and I have a line of credit, and then I have a checking account, so three things, right? Yeah, your checking account or money comes in. Let me write it. So I'm gonna confuse myself. So we got a checking account. Not even wasting time, guys. We're just going right into it. Checking account. We have a line of credit, and we have a credit card. Okay? When you make money, like everyone else does, it gets deposited into a checking account, right? We understand that. Cool. She's asking about using credit cards and line of credit simultaneously. So we know that there are bills that can and cannot be paid with a credit card. And what I mean by cannot means like you have to go an extra step, such as taking a cash advance, a balance transfer, where that incurs extra fees. So that's where I say can't. It can be done, but it's going to cost you money. And when we're doing velocity banking, we're trying to minimize our cost of borrowing money. In fact, we're trying to make money in the process by saving money, increasing cash flow, and saving money on interest, okay? So what you would do for my friend Brogada, pretty cool name, is you have your bills that can be paid, right? Bills, you're gonna pay your bills that can be paid with a credit card first with the credit card. And then when this money comes in, you should have already made a chunk, right, from the line of credit to pay off debt, okay? And I think she told us how much she got. Let me see. So you got a $35,000 HELOC. Okay? Got a $35,000 HELOC. So before you start using your credit cards and whatnot, you should be making a chunk towards a certain debt to increase cash flow, right? So we did that. Let's say you did that already. And then the next step is you dump all your income back into that line of credit to satisfy the payment and to also prevent any interest getting charged to your money that you made. So you can keep 100% of that by simply shifting it the same day you make the chunk. That's the best way to do it, okay? And then now, to keep most of this money in the line of credit for a longer period of time, you're using the credit card to pay bills that can be paid with a credit card, and you might get some cash back rewards, statement credit, points, miles, whatever, right? So there's a little extra bonus there. Now, what you were getting into was setting up the automatic payment. So instead of paying the minimum payment on this credit card, you should be paying the statement balance each and every month in full on its due date, okay? So on the due date of that credit card, you should pay the statement balance in full from here, all right? Now, there are some credit lines, personal line of credits, HELOCs, that do not come with a card, like a credit card. So you would take the money back out of the line of credit to the checking account. So you'll make a transfer back to your checking account on the day that that credit card is due or the day before, just to be safe, and then make your payment to the credit card. You could set up an automatic payment to come out of the checking account for the statement balance. So you're not making, the way you wrote it, maybe you just wrote it wrong, but it sounded like you were saying take a transfer from the credit card and pay this. No, we're not doing that. So we're using the line of credit to pay back the credit card, or if they do not provide you with a debit card, credit card to use like a checking account, literally with the line of credit, then you have your normal checking account where money comes in, and then you set up the automatic payment for the statement balance. This way you prevent ever having to get charged interest on money that you were already going to spend anyways, right? So we don't want to incur any extra fees there, okay? So I hope that was helpful. And let's see, good morning to everyone. Today is all about answering your questions. All right, so I'm gonna do a little Q&A. I'm gonna run a scenario as well. So looks like I'll just be reading the comments, answering your questions as I move along. But I do have a very cool scenario for you guys that I think you'll enjoy and I think you'll learn a lot from. Let me see who else is in the house here. Okay. Hello, Dave. Hello, Terry. Brogata, yep. It is all cleared up. Hope that helped big. Fitness challenge, good morning. This is my first month using the HELOC. Nice, nice. Good morning, Joy. Pete, how you doing? From South Africa. Wow. I don't think Velocity Banking works over there, but that's pretty cool. Getting people from other continents. Andre, how you doing? Good morning. All right. So this is going to be a very slow pace video class, okay, where I'm gonna pretty much walk you through exactly how I communicate with my clients, how we break down a financial plan to either pay off debt, increase cash flow, build your credit, establish a high cash value life insurance policy, save money tax-free, use money tax-free, 10x your business, 10x your lifestyle, invest in real estate, right? Different things that I like to cover. And so I want to, really go nice and slow. Whoever has questions, definitely submit your question early so I can look back and then I'll, go through it. Any questions that pop up from this particular scenario, right? Put it in there and we'll get things going. So we always start with the 4 major numbers. What's your monthly income? How much do you spend? what's your total debt, and then what is left over at the end of every month, being your cash flow, okay? So we have a scenario, gentleman, making $3,920 a month. I believe he drives trucks. His expenses are $3,236.96. His debt, not a lot, $13,939.59. Cash flow, $683.04. We are in the state of Texas, so we have a personal line of credit, unsecured, with Texas Federal Credit Union, I believe. I forgot. For $14,950. The max with that specific bank was $15,000, and he got a 12% interest rate. All right. His goal is to pay off all his debt, establish a high cash value life insurance policy, 10x his income, build his business, invest in real estate. You know, we all have very similar goals, guys, right? So let's see. In his numbers, he is currently saving $2,000 a month. So even after his expenses go out, I believe the way he calculated it was like his expenses, this is perfect when people do this, is he factored in saving as an expense. So he's saving $2,000 a month, so it's included in here in his expenses. So what happens is even after saving $2,000 a month, he still has an additional $683.04 that goes nowhere. Okay? So he's saving $2K a month. So that's the first thing. And then we currently have $4,000 cash on hand. All right. So that's another key thing to understand. And let's see what else we got here. Bear with me. So we're looking to fund a policy by February. Now, the reason why we are considering looking at opening up a high cash value policy is he does meet some of the factors in terms of has a debt tool, we have some capital, we do have okay cash flow. I mean, technically, when you look at it, his cash flow is $2,683 a month, right? So he's got good cash flow, very low debt, and has plans of increasing his income, which I believe he is going to go from making just under $4,000 a month to bringing in about $20K plus on the conservative side. So there is potential to earn a lot more, but that is something very key to point out, and I believe that will come for him in April of 2020. April, maybe May 2020. So that's what we're looking at in terms of growing his income. This is from his coming business that he's building up, which he's going to buy a truck. I got an eyelash in my eye. Shoot. All right, so he's got this truck that he's looking at that he needs to purchase, and the down payment is going to be $15,000. Okay, $15,000 for a down payment on a truck that I believe will be financed at $70K. So $15,000 down payment. For a truck. And I think it's a $70,000 truck. Okay. And I believe the payments will be $1,000 a month. I believe that's what we were looking at originally. Okay. Planning on getting the truck. Let's see. April. Yeah. So we're going to get this truck in April 2020. So he needs to have $15,000 cash come April 2020. Should his income jump, I mean, we're definitely going to have that, right? So we are in January. Today's what? The 11th? No. Today's the 9th. I'm way ahead. Today's the 9th, January 9th, Thursday. Spoke to this gentleman, I think on January 6th or 7th. And we're going to have $683.04 plus $2,000 for the month of January. And then let's just calculate February, March, April. So I'm going to have all that savings plus cash flow. And then I also have this line of credit that I can use. So what I was thinking was, instead of saving up money to buy a car and then have that money never come back to me, I lose it, right? So if I was to just save up the $2,000 a month plus the $683.04 for the next 3-4 months until I put a down payment on the truck, I should have about $15K, all right? I mean, let's do the math. Let's see. He's got $4K on hand, right? January, February, March, April. So 2 times 4, that's 8,000. 8,000 plus 4,000 cash on hand, that's 12,000. And then do 683. 683 times 4 months. That's $2,732.16 plus $12,000. He has $14,732.16. Okay? So he'll have the $15K to put a down payment on the truck, and then every month thereafter, his savings capability would go down by $1,000, but because of his income jumping, we won't even factor that in. It'll be non-existent. It'll just be, his expenses will go to $4,236.96. In fact, he might change his savings game and increase it quite a bit. So that's one way of doing it, right? I can just save up the money now so I can get this truck so that he can position himself to make that big money, because I believe he needs the truck to make that kind of money. I believe that's how that is going to work for him in his trucking business. So that's one way of doing it. He'll still have this debt, so we're basically ignoring the debt, right, to get that truck, acquire it, make the money, and then basically like in 2-3 months pay off the whole thing. That's one way. Simple, right? No arguments there. But the money is gone. I lose that $15K, right, that I saved up. How do I acquire an asset? In his case, this truck is going to be a very high valuable asset for him. So how do I acquire something, pay for it, but also keep the money in return? So we're going to use the same numbers, that 14,000 that I'm going to accumulate over the course of a certain time period. And then we have this line of credit. So $14,950 times 66% is $9,867. Okay? So we can leverage our existing personal line of credit up to this number is what I normally would do. I don't like to over leverage myself. So 9,867 is one number. I have 4,000 cash on hand. I'm gonna have 2,000 at the end of this month, saving, right? And then 683. Okay, so let's add that up. 9,867 plus 4,000 plus 2,000 plus 683.04. So that's $16,550.04. That's one number. This gentleman is also looking at acquiring another line of credit with Wells Fargo. He's been banking with them for quite some time. So he's looking at obtaining, I believe, a 20 to 25,000. He's got very good credit, so I believe he has a good chance of getting that. If I had a $25,000 line of credit to work with, then I would ignore my smaller line of credit. No sense in borrowing from that when I have more capital and potentially a lower interest rate, because the higher you go with these credit lines, typically the lower the interest rate is. And I believe with Wells Fargo, 20 to 25K, I've seen rates between 9 and 11% throughout the United States, and possibly even less than that. So if I had a $25,000 line of credit, times that by 66%, that's 16,500. If I had 20,000, times that by 66%, that's 13,200. Okay? So you can just take one of these two numbers and add it to the 4, the 2, and the 683, and let's see what we get. So I'll start with the lower number, 13,200 plus 4,000 cash on hand plus 2,000 I'm going to have at the end of January this month plus 683.04 puts me at 19,883.04. Okay? And then the other one, 16,500 plus 4,000. So it's 2,000 plus 683.04. So 23,183.04. Now you're like, okay, why is Denzel putting all these weird numbers? Well, let's put it together now. So looking at the infinite banking concept, all right, I asked you the question earlier, how can I acquire something, pay for it, and keep all that money, never lose it, and have the ability to use it again in the future? So basically what I'm doing here is I'm making my money usable more than once. Instead of just saving it up and using it, I'm doing something where I'm going to put it somewhere where I have the ability to take from it and keep it. I can make $1 2. I can make $2 4. How is that possible? Let's put it together. Okay? So looking at the infinite banking concept, we're talking about whole life insurance with cash value, with the ability to earn money tax-free, use money tax-free via policy loans, right? So look at my illustration here that I designed for my friend. So we went ahead and put a policy together. Okay. Policy. This is whole life with a life insurance company called Guardian Life Insurance Company of America, I believe. Putting in, so we're going to fund $40,000 a year, $40K a year. That's the number that we came up with. Why did I come up with that number? That was from the client, pretty much. That was what he would like to do. If you take into consideration saving $2,000 a month times 12, it's $24,000. Then we factored in, okay, if we were debt-free, how much more cash flow will we have? And that put us up into the neighborhood of 30, 35K. And I was like, round it up, call it 40. And that's conservative without even factoring in what I could be making for the rest of 2020 after April or May, right? $20,000 a month, he'll easily fund that. So when we're saying that we're gonna fund 40K a year, we're asking for the ability to do that. So that's gonna be my max number, 40,000. With that being said, if my policy is designed properly for the infinite banking concept, then my premium, my cost of life insurance, right, cost of life insurance should be no more than $4,000 if I want the ability to put in 40, okay? So it should be no more than that. So this would be what's called a 90-10 split or 10-90 split, meaning 90% of the 40,000 would go towards the cash value, right? And the other 10% goes towards the premium. If you get a policy designed like that, you're going to outperform majority of other policies, other designs that are out there, period. Because you have all the money you possibly can according to the IRS limitations. You've hit the max, okay? So that's the max that you can go. So his starting cash value will be somewhere in the neighborhood of $35,000. So, first question that pops up is, wait a minute. I put 40K in, and you're telling me 4,000 goes towards the premium. That's my cost of life insurance. Well, 40,000 minus 4 is 36,000. So shouldn't I have 36,000 in cash value? No. Why? Because we have some other cost included. So this is just the cost of my whole life, right? Now, most people know that whole life insurance is like the most expensive type of life insurance that you can buy, okay? Because you're covering yourself for your whole life. So when you're looking at life insurance, understand that whole life policies will overcharge you in the beginning years, and then in the later years it starts to go down. With term life, it's opposite. Term life insurance is super cheap in the beginning, super expensive in the end when you actually need it, right? So it makes you think, what should I do? Well, what if you could have the best of both worlds? Taking a look at infinite banking, if I'm designing a policy to maximize cash, minimize cost, so I'm lowering my cost of life insurance up front as much as I possibly can for the most amount of cash value I can possibly get. In order for me to actually do that, in order for me to actually get in $40,000 a year into a policy, I have to have term life. I have to have a bigger death benefit, okay? So for this particular case, a 29-year-old male, so 29-year-old male, the cost of whole life insurance for him for $4,000 is coming up as $352,941. Okay? Now, if you were to put $4,000 a year, your annual expense, in a term life insurance policy, you would get like way more death benefit. Way more. Why? Because term life is cheaper than whole life. Another reason why is term life insurance policies typically expire before the person dies. So the risk to the insurance company is like damn near zero. There's a statistic that I read one time in many different articles about like term life insurance policies in general over like all the insurance companies in America. About, I think it was like, I saw a number 2%. It could be a little higher, but probably no more than 10. I would say maybe 2 to 5% of term life insurance policies actually even pay out to the beneficiary. Why? Because the thing expired. It died before the person actually died. Because they thought, oh, let me get the cheapest life insurance I can now while I'm young, and then, I don't know, maybe I'll be rich when I'm older. And the majority of people, that is not the case, okay? So when we're doing it this way, we're gonna get the best of both worlds. So far, we got $4,000, that's buying me $352,941 of death benefit, whole life. The other $36,000 from the $40K is going to purchase me cash value, right? Life insurance, right? Cash value account. And it's also going to get me term life. So his term life is going to purchase him, let me see what the number is there, $442. So for a 29-year-old male, $442.73 a year, right? This is 1 year. In other words, it's called OYT, 1 year term life insurance. $442.73 will buy him $1,447,059 of death benefit. You're like, damn, that's really cheap. Would you agree? Sure. $4,000 only got me $352. $442.73 got me $1,447,059. The reason why we need to have this in our design here is so he can actually overfund the policy itself, right? So in addition to this 1.44 million, oh, you know what? I made a mistake. It's actually 1.2 million. And I'll explain. Let me fix that. 1.2 million. So $442.73 buys me 1,229,000. Not much of a difference. $814. Okay. And then this cash value is also going to get me more death benefit, which is where I got that 1.44 from. So let me see. $1,447,059 minus $1,229,814. So $217.245. So we have $36,000 now that goes into his what's called PUA, paid up additions. I'm paying up my life insurance ahead of time. Watch this, right? Dealing with whole life. I'm overfunding the policy in the beginning years. So I'm getting past the cost of life insurance by simply overfunding it ahead of time for a period of time so that I can benefit from having all of this death benefit and this death benefit and not actually have to pay for it when I get older, when I actually need it. This is pretty cool. So 40,000 goes in, 4,000 went towards life insurance expense, got me 352,941, another 442,73 from the 40K buys me 1.2 million of death benefit. 36,000 went into PUA. Of that 36, you minus 442.73, right? And then the actual PUA, the money that went into cash value, also purchases me more death benefit. So it gets me another 217,245 of death benefit. So his total death benefit will be 1.8 million to start. All right, and that's if he puts this policy in place by February 2020. Somewhere around February 2020, could be like the middle towards the end, I would assume, because I'm sure he's going to want to also include cash flow gains for the month of February, and that'll increase these numbers right here. So far, we're saying to the insurance company, I want to put in 40, right? But I have anywhere from 16 to 23 to work with by February 2020 to start this policy. So I don't actually have all the 40K, which is fine. The way this would work is he would put an initial amount to fund the policy with. Whatever that initial amount is, 4,000 will go towards the cost of life insurance, and then the rest would go towards the PUA, and he'll have a lower death benefit to start with. So the max in 1 year for him will be starting out at 1.8 million. So I wanted to break down the cost. And the strategy here is I'm using my existing money that I'm saving. I'm using the bank's money, leveraging that debt, right? On top of having debt, I'm leveraging more debt and saving money. And I'm putting it in a better account. Right? So I'm putting it in here so that I can get an asset, one, right? Which is be the death benefit, which we don't really care about right now. 29 years old, doesn't have children, doesn't have a family yet. We could care less. I could care less about death benefit. Even my 50, 60-year-olds that are doing this, we care less about the death benefit, more about what we're going to do with the money, right? So money gets shifted in here. I get the asset. Now I have cash value. This cash value functions like a line of credit. It will perform like a line of credit. I'll have the ability to take money out and put money in whenever I please, okay? It's a bit of a longer process, right? It takes time to actually get your money. It takes a few days to actually borrow the money, and then it takes a few days for the money to actually hit the account and register and all that good stuff, right? So if you were comparing a line of credit from a cash value account, the line of credit will work faster for you, which is why I like having that in the first place. So when I'm doing velocity banking and infinite banking together, typically I'm using the bank's money to form my own bank so that later down the road, I never have to use them. I never have to borrow money. I can borrow money from myself at zero. The primary goal of velocity banking is not only to pay off debt at a faster rate than debt snowball or debt avalanche, but on top of that, we want to have the ability and the knowledge to actually use that money over and over again for other things, such as acquiring assets, building wealth, building a kingdom. Okay? So, where am I at here? It's a lot of information. I hope you guys are enjoying this so far. Let me turn to some Q&As here. Let's see what's going on in the house, in the chat box. Let me scroll this thing up. I know a lot of you asking questions. Let's see. Hello, Mary, Mitchell, Mindy, Quentin Smith, Wesley Sump. Good morning. Wink says, I just got granted a $90,000 HELOC. Only debt is my mortgage, $3,000 in expenses, $10K income. How much should I chunk? $3,000 in expenses, $10K income, $7,000 of cash flow. Do the math. I have a $90,000 HELOC. Take the $90,000, times it by 66%, you get a number. Take your cash flow. If it's 7,000 or less, I don't know. Take your cash flow, times it by 12, you get another number. Whichever number is greater, or whichever number you feel more comfortable with, somewhere in between what your cash flow is times 12 and what 66% of the line of credit is, should be my chunk towards the mortgage. Especially if you don't have any other debt whatsoever. That's pretty cool. So you're just literally HELOC. So I got checking account, HELOC, mortgage. Checking account, HELOC, mortgage, right? The HELOC, take money out, pays the mortgage, income comes in, 10K, put it in the HELOC, and just keep going like that, like that, like that. And then you can learn salsa because your wife is going to be like, honey, the house is almost paid off. Oh my God, you look taller. Wow, you're standing up straight. Wow, things are going well, honey, right? Let's see. So let's come back to this. Let me come back to this. I'm gonna answer those questions. Don't worry. Don't worry. I'm gonna answer your questions. Let's see. So let's say for this gentleman here, these were the numbers, right, that we were coming up with. Now he is projecting, person on the board here, he is projecting to have 22,000 to work with, to initially fund the policy, what we have ironed out here, okay? So coming back to, I don't think I ever answered the question why the cash value was less. It's because some money went towards term life insurance, and then there's something called a PUA fee. It's 5% of what I put in, right? So then at the end of the year, so this is including what I earned in dividends for a whole year, his cash value should be at 35,000. He'll probably start with, like when he initially funds the policy, he won't have 35,000 to work with because we're only putting in 22. Make sense? So He's going to put 22 in. 4,000 will go towards the premium. Okay, so that leaves me with 18,000. And then however much term life insurance I need to cover the amount, the extra 18,000 that I overfunded the policy with, so it'll be less than 442, maybe half, right? Because 22 is basically a little over half of 40K. So you can cut that number in half, and then we can cut the PUA expense fee in half. So if I'm gonna have 35K to start with, then that was 4,000 in cost of life insurance, and then like another 1,000 plus in the term life insurance, and then the PUA fee. So let's just minus 1,000, just to be conservative. And we could safely say that he'll have about 17K in cash value or less to start with. However much cash value I have to start with, I can borrow, what is it, 90 to 95%. I know it changes with different companies, but I believe with Guardian it's either 90 or 95, I forget. So I'm gonna go with the 90 number. So if I have 17K starting, 17,000 times 90% is 15,300. So maybe I have 15,300 to actually leverage, to borrow from. Okay. So in this case so far, I'm in February 2020. I fund the policy, I throw 22,000 in. I got 15 plus K to work with. I don't need to buy the truck just yet. That is the goal, but I don't need to buy it just yet, right? Now I'm in debt on whatever I borrowed, whether it was from the first line of credit or the second one. Okay? So whether or not he uses the first one or the second one, he is for sure projecting to have 22,000. And I did tell him, I'm like, look, if 22,000, that's the primary number, you could go a little higher on your chunk. 14,950, if that's all I had to work with, maybe I do an 11K chunk, you know, or whatever the case may be. Let's also factor in that in February, he'll have, like at the end, he'll have another 2K and another 683.04 to work with. So if I got the 25K line of credit, then I don't have to worry. I borrow 16.5, and then 4 and 2 and 683 was capital in addition to the 16.5. All goes into the policy. So let's take a look. Yeah, so if I got 15,000 to work with, the first thing that I mentioned was, in his case, I was like, look, we could actually pay off a debt before we actually get to the truck. We could. Watch this. So he has 3 debts that total up to the 13,939.59 that we see, right? So he has an existing car for, let me see. He's got a car, 6,244.02. Okay, and the monthly payment is $346.89, and I don't have the interest rate. It's probably like 5 or 6%, I forget. He has another debt with a credit card of $5,523.87, and the monthly payment's $46. And then he has student loan, $2,032.70. Okay, and the monthly payment is $108.99. So the first thing that came to my mind when I'm looking at these debts, and I'm like, okay, got $15,300 to work with. I just borrowed all this money from a line of credit, 66%. I used all my capital that I had on hand, started this asset, got this $15K to work with. I said, hey, I think you should borrow the $6,244.02, which would be less. Come February, he has to pay January's payment, so that balance will go less. So I'm just, for argument's sake, I'm just gonna, keep the number the same. Keep it simple. $6,244.02 or less. I borrow policy loan. So I take out a policy loan for $6,244.02, right? Now here's the fun part of how this borrowing game works, right? So I have cash value of, say, the 15,300. No, I'm sorry. The total cash value is going to be 17, right? But I can only borrow 90 to 95%. So I'm going to put 17 on this side, 17K. And then we have a policy loan for $6,244.02. And on the other hand, we also have debt on HELOC, on the personal line of credit, of whatever he chunked, whether it was 16K, 13K, the 9, maybe he has more cash flow to work with. Maybe he has other funds that he can tap into. I don't know. But we know that I'm just working with the 22K example here. So debt on the HELOC, let's just say from the 22,000, if that was a number, I know for sure I've got 4K in capital. I have 2K for the end of January, and then 683.04. So maybe he borrows the max from the numbers that we have on the board here, $15,316.96 from the line of credit. So in order for this number to actually be true, he would have to get the higher line of credit, get approved in the next couple weeks, 20 to 25K. If this is not the number, then we know for certain that, on the low end, at least 10, the 9,867. So I'm just going to put anywhere between 9,867 and $15,316.96 is what he would borrow from the line of credit to actually be able to hit that 22K number. The only reason why the number would go lower is if he has more existing cash capital, right? So if we wait till maybe the end of February, right, or to fund the policy, just depends on how it all works out. But just know that he is going to have debt on the line of credit. So we are going to be paying what? Interest, right? Because we borrowed money to fund our own asset. Okay, so you have that. Over here, we have the $17K in cash value, and I got $6,244.02. When I borrow from Guardian, let me see, the interest rate is 6%. Okay? So we're going to have 6% owed that the insurance company is going to be charging me on the money that I put in there. Right? So 6%. But they're also going to be crediting me 6%. So they're going to be charging me 6%, but they're also going to credit me 6% on whatever money I have borrowed, the $6,244.02. So $6,244.02 times 6% is $374.64. That's how much I should get charged, and that's how much I'll earn on that money. Over here, 17,000 minus 6,244.02 is $10,755.98. So the current dividend rate for Guardian was 5.85%, and I believe it dropped to 5.6. Let me see. I forget. I'm going to use 5.5. I think it went down to 5.65% or 5.6 for 2020. I don't remember. But I'm going to use 5.5. So the $10,755.98 will earn 5.5%. So $591.57. Okay. The way this works is with whole life insurance, the Guardian, the guaranteed rate of return is 4%. Anything above 4%, so 4% is your floor. Anything above that, they classify that as a dividend. So we're getting 4% plus a dividend of 1.5% or 1%, whatever they give us at the end of 2020. So $591.57 I'll be earning on the money I did not borrow. The money I did borrow is actually going to be earning a little bit more than the actual dividend rate. So we got $591.57 plus $374.64. So that puts me at $966.21. So even though I borrowed this money, and when I borrow it, what am I doing? I'm going to pay off that debt and get a cash flow gain of $346.89. So March, April, $346.89 times 2, $693.78, right? So I'll have an extra, where can I write it? I'll have an extra 693. What am I doing? 693.78. Perfect. For paying off that specific debt. And then at this point, I'm not going to pay this back. I'm going to leave this alone. So that $6,244.02 will be an outstanding policy loan on this policy that he starts. I still have $10,755.98 to work with, right? That I can borrow from. Sure. For the month of February, March, April, and maybe May, I do velocity banking on the line of credit. Right? So $3,920 goes in. Okay, $3,920 goes in. My new expenses are now, let's see, $3,236.96 minus $346.89. So my new expense number per month should be $2,890.07. So here's what's going in. Here's what's coming out of the line of credit. And then you get your, whatever your remaining balance is at the end of February going into March. Okay? So if I borrowed $15,000, let me just go with the high number, $15,316.96 minus income, $3,920 plus $2,890.07 expenses. Balance at the end of that month on the higher line of credit would be $14,330 maybe. Whatever the interest rate is, maybe he gets like a 10% rate. Won't be too far away from the 12. And then I do velocity banking. But see, now we're no longer going to save $2K a month, right? We're not doing that anymore. So all the, did I make a mistake? I think I made a mistake. Because I'm not saving money anymore, that means his expenses, the money that's actually coming out of the line of credit, will be a lot less. So let's correct ourselves here. Remember how I was saying earlier that he factored in the expenses he counted his saving as an expense. So $3,920, okay, $3,236.96 minus $2,000, because I no longer have that, minus the $346.89. So $890.07. I believe he lives at home, which is why his expenses are super low. So let's just say 1,000. I have 890. I'm gonna overestimate and say his expenses will be 1,000. $1,000 bucks, right? And that's money that will be coming out of the line of credit. If I'm no longer saving money in a separate account, in a savings account, because I'm doing velocity banking, then I keep that 2K, I keep it in here. I keep it in the line of credit. So whether he is making $3,920 a month, or maybe he was making $5,920 a month and then pretending like he's making $3,920, whatever it is, however it works for him, all of his income on a monthly basis will be going into the line of credit after we fund the policy and after we borrowed from it as well. I'm not paying into the policy. My policy is paid for the whole year. I don't have to pay into it. Everything I did above the 4K is overfunding. We're doing velocity banking over here. Here's the primary focus now. Primary focus is to bring this debt to zero balance or close to it as fast as possible. So I have February, March, and let's say April, okay? Just by going by the cash flow, right? 2,000 plus the original 683.04 plus the 346.89, March and April would equal $6,059.86. Okay? So cash flow, $6,059.86 for sure is what the line of credit would drop by, however much I originally borrowed. So if I borrow $15,316.96, I have a guarantee that the balance will be $6,059.86 less. That makes sense? Doing velocity banking, all my income goes in, expenses come out, cash flow stays in. The cash flow, 100% of that stays as principal because I dumped all my income in. So I don't get charged interest on the money I put in, only what I'm taking out, okay? Which in this case would be the expenses and then the existing debt that we borrowed originally, okay? So with that being said, remember, the other primary goal in order to boost my income come April, May of 2020 is I gotta put 15K down on a truck. So whatever the balance is on the line of credit, we don't actually care, okay? For sure, look, 15,316.96 minus 6,059.86. So end of April going into May, my balance on the line of credit, if I borrowed 15K plus, will be somewhere around 9,000 or less. And if I had a $25,000 line of credit, remember how I said 16.5? 16.5 would be the chunk number. So let's see, 16.5 minus 9,000, I've got 7,500 of space to chunk. Yes, would you agree? Of course, right? And then if it's less, if the original number that I borrowed to initially fund the policy is less, then obviously the balance on the line of credit would be less as well. And with that being said, my second chunk, so my first chunk was to fund the policy. My second chunk will fund the policy again. But now we're not going to pay this back. What we're going to do is we're going to add more money to the principal cash value to try to hit 40K. Get it? And when I do that, I'll have more cash value to work with than if I was to just pay myself back the $6,244.02. Because even though I have $6,244.02 outstanding, when I log into my life insurance account and I go on the desktop and I log into the portal, it'll show 17,000 in cash value. What's available to use? 10,000. But what I have is 17. The insurance company did a collateral loan. They gave me their $6,244.02 and they used my cash value as collateral, and they charged me interest on their money, and then they paid me interest on my money, and it offset my borrowing costs over there. My only borrowing cost is over here on the line of credit. I offset that borrowing cost on the line of credit. Why? Because I paid off the car and I got a cash flow gain and saved interest over there. So I removed that institution off his credit report and I put it over here so he can pay himself back the $6,244.02 from the 346.89, and he keeps all his money in the process, and debt gets paid off, and I save money on interest, and I increase my cash flow. I'm on a roll, okay? I'm getting hot now, ready? So second chunk, whatever the number is, we know for a fact it's going to be more than $6,059.86, right? Let's just say I did that. $6,059.86. Add it to the 17. 17 plus $6,059.86. So his new cash value will be somewhere around $23K, give or take. That's very, very conservative. From what's available though would be the $10,755.98 plus $6,059.86. So $16,815.84 is what I would have beginning of May to put a down payment on that truck. Now, I'm not just going to chunk my cash flow. We don't do that in Velocity. We don't just chunk cash flow. It doesn't make sense. So we need to chunk a little bit more. So remember how I was saying that 7,500 was one number. So I can probably chunk anywhere between 7,500 and maybe 12K, right? We don't mind. We don't mind having a debt over here because of what we're about to get into, okay? So come April or May of 2020, I'll make a second chunk of somewhere around this number, no less than 75, maybe more than 12, but we'll see. It depends on how fast he moves, how much he knocks down on the line of credit. Remember, I don't want to breach 66%. Too much. Maybe I go to 75, but I don't want to go 90 and up. Okay, I don't want to almost max it out. I like to keep a nice a space in there, right? So second chunk goes in there, boom. Now I have the money, so it'll be 23, maybe it'll have like between 23 and 27K cash value to actually work with. He initially put in 22,000. If he adds another 10, let's say, that means he's put in a total of 32, and then anywhere between 23 and 27 or more shows up in cash value. I'll have the ability to take another policy loan for 15K and then put a down payment, boom, buy the truck, have the $1,000 payment, whatever it is. Cash flow will go down $1,000 maybe the first month, but once he's got that truck on the road and he goes a full 30 days, boom, here's what we're looking at, 20,000, right? Once I jump to $20,000, maybe his take home from that's, I don't know, 15 or maybe less net. Whatever the number is, it's going to be way more than 3,920. Would you agree? Of course. So now I've got all of June, July, August, September, October, November, December. I got 7 months to do velocity banking on the line of credit to bring it back to zero. And then I have time to also restore the policy loans by the anniversary date, February 2021, and max fund the policy. I'll have the ability to do that, no issue, right? And then when I step into the 2021, then I fund another 40K, and this becomes his savings account, his tax-free savings account. That's going to earn him anywhere in the neighborhood of 4 to maybe 6% tax-free for the rest of his life. He funds it for a certain period of time, maybe 7 years, maybe 10, maybe 15, maybe 20. After I'm done funding the policy, we will turn it into a reduced paid up, RPU, reduced paid up, which means that he'll no longer pay this and he'll own his death benefit. He'll own it. It'll all be his, which he never has to pay for again. So unlike term life insurance being cheap in the beginning, super expensive at the end, whole life being expensive in the beginning and having to pay it your whole life, and it gets, less and less expensive over the years, we get the best of both worlds where we have both in the beginning for the minimum amount of cost possible, for the max amount of cash value usage now. I get to use the money now while I'm alive. Get to use it now, use it now, use it now. And then I own it, never have to pay another dollar into the life insurance again. So according to the illustration that I'm looking at, so I have it designed where he puts $40,000 for 7 years. So that would be a total of $280,000 in principal that went in, right? Principal money that went in. His cash value will be somewhere in the neighborhood of $300,000. Okay? And then what happens is once you're done funding the policy, the term life insurance will fall off. Okay? Every year, the cost of your term life will drop little by little because you're paying up most of the death benefit in the beginning years with the $40,000. So what happens is when we get rid of the term life insurance expense, his death benefit will drop a little bit. Again, we don't care about the death benefit. So his death benefit will drop to somewhere around 1.5 million. And he'll be 35, 36 years old. $1.5 million death benefit doesn't cost him a dime for the 1.5. And he'll have a line of credit for $300K, which he can purchase real estate with, which he can fund his business further and 10x his income, whatever he so pleases. Okay? Now, here's what happens. Throughout the years, that cash value has to earn interest and dividends and interest and dividends. Okay? So, what happens when this number rises? The death benefit has to rise as well to avoid what's called a MEC, a modified endowment contract. So when from age 36, right, so he'll be 36 right here, 36, 37, whatever it is. He'll have 1.5 million, 300K. When he turns retirement age, is 59 and a half. When he's 59 and a half, his death benefit at 59 will be back at the 1.8 million. This is super cool. And then let's say this guy lives to be a nice old man, grows old to the age of 90 years old. At 90 years old, let's say he passes at 90, right? He'll have a death benefit of 2.7 million. So at 90 years of age, 2.7 million. Let's say he lives to be 100, because with all the science and all the technology upgrades and the way this world's moving super fast, people are living longer. Hey, I don't see 100 being that hard of a number to get to, right? In terms of the times that we're living in right now. So let's say he lives to be 100 years old. His death benefit would be in the neighborhood of 3.2 million, right? 3.2 million. For my math people, what is the return on investment if I put 280 in and got 3.2 million back, or I put 280 in and I got 1.5 back, right? Let's say I max funded the policy for 7 years and I pass away. Would that have been a bad thing? Shoot, I put 280 in, you're gonna give me 1.5 back to my family? That's pretty awesome. Plus, during that 7 years, I basically had the opportunity to use the same money to create more wealth, right? Create more wealth. It all started with that 15K down payment on the truck. And we managed to pay off debt. So notice how if I would have went the simple route in the beginning, just save the money up, buy the truck, that's all you would do. But in this case, I would have done the same exact thing with the same exact money, except I had an advantage. I had a line of credit that I borrowed from, I established an asset, I actually paid off debt, increased cash flow, almost max fund a policy, and I kept all the money in the process. I kept the bank's money. Now it's my bank. Now it's my own money. Right? I kept it all for myself. Right? So that's pretty powerful. Any questions on that? Okay. So let me turn it over to Q&A now, because I'm sure you guys have a lot of questions. And we got 49 people in the house. You guys have been super engaged and patient. And now we're going to answer some questions. Okay. Okay. Hi from Canada. Cool fitness. Let me see if I can move my table a little closer to me so I can see. All right. The first question. I watched quite a few of your videos before I decided to jump in. I love your examples. Great, great. Hidden, unknown, I got this. Yes. Andre, good morning, everyone. Hidden says, I'm glad to met you and think you are a blessing. Just paid off 4 credit cards using your videos and Velocity Banking. Sorry, wasn't able to opt into your program yet. No problem. Hey, if you're getting results and you haven't even signed up for any of my programs, that makes me super happy, because I know it's going to get you one step closer to starting a policy, and then creating wealth, building your kingdom. That matters more to me than simply revenue, right? Listen, my source is God. So he provides me with the resources to help you practically for free, right? And then because I work, Bible says a man should get paid for his work. So people pay me money because they believe in me, they know, like, and trust me. They sign up for one of my programs, and I do something like this for them. And then one day they turn on the YouTube channel and they go to one of my videos and they're like, damn, that looks like my numbers. That is my numbers. Wow, this is perfect. Now they have it for life. Okay? So I just mapped out this whole dude's thing for the first pretty much year. And this is what I do for my clients all day long. I just map stuff out. Record it, edit, it's there for you. I don't use names. I just use male, female, age, right? Only you know it's your numbers. And even if you think it's your numbers, it could be like literally the same to someone else's. So, I keep the confidentiality, on the high, okay? Quentin Smith says, what's the best whole life insurance company to go with? I have a policy with Guardian and Mass Mutual. Those are my answers so far. Now, if I ever meet another infinite banking agent or a whole life agent or insurance agent that can convince me that their design is better for the infinite banking concept. So your question is too broad. You're saying, what whole life insurance company should I go with? Gee, I don't know, right? But if we're talking about infinite banking and doing things like this, then the company is important and the way the policy is designed. Is it a 90-10? So you could look at if anyone is in here with an existing whole life insurance policy, you could simply call up your agent and ask them, hey, what is the split in terms of what I'm putting in and what I'm getting back in terms of my life insurance, my cash value, my premium? How much of my money is going towards premium every year? Most policies, 100% of your money is going towards premium because you purchased life insurance. We are not purchasing life insurance. That is not our goal. We're not trying to do that. We're trying to purchase our own bank, small bank, tax-free bank to function like a line of credit, and it just so happens to come with a death benefit. Okay? So when you ask the question a little more detail specific, then I'll be able to help you a little bit further with that. Let's see, next question. Hello, how do I create an account for bank affiliates? I have a problem with the boss of my company, but I don't know what tax he pays. At what? I need to create a log of payments before Sunday. Please help. I have no idea what you're asking, my friend. You're going to have to be more specific. Hello all, for everyone on here. Know thy numbers. Love it. Love it. Hidden first needs to clear his debt, then work on whole life policy. Okay, he must be talking to someone else. Ned says, hello. If I was going to make a business, what would I do and want to make a business? Okay, let's answer that. So, let's take a look at that. Let me read that question one more time. If I was going to make a business, what would I do and want to make a business? Okay. Your grammar's a little off, but that's okay. I know you was typing fast. It's okay. It's okay. All right, let's see. So there are 4 major questions in life. Just like you have your 4 major numbers, there's 4 major questions in life. And the faster you answer these questions, the faster you will achieve your goals, your wants, and your desires. 4 major questions. Okay? The first one is, who am I? Once you figure that out, and I have an easy way to answer that, it's your name. That's who you are. Your name, right? What does your name mean? I don't know. You got to figure that out, okay? Once you get that question down, then the question poses, well, okay, who am I? Denzel Napoleon Rodriguez, 23 years old, right? You put your work, your history, your experience right after that, and things that you do, wants, desires, purpose, okay? Then the question comes, well, why am I here? Right? So, why are you here? We are the only species on Earth that asks this question. Monkeys know why they're here. Dogs know why they're here. Cats, fish, the birds, the whole animal kingdom, they know why they're here, but we can't seem to figure it out, and we're at the top of the food chain. What's up with that? So you got to figure that one out. Why am I here? Best way to answer that is by figuring out what made you. Who made you? How did you get here? Mom, dad, okay, but then who made mom and dad? Who made their mom and dad? Okay. We get some data. We start getting a little metaphysical, right? Is that what it's called? We get a little into the quantum, into the science, into the spiritual, okay? So why am I here? Shoot, what's the next one? Once you've figured out who am I and why you're here, the way you answer that question is by figuring out who the manufacturer is. Manufacturer, oh my God. Did I spell it right? Manufacturer? Oh no. I'm on live, YouTube live. Siri! How do you spell manufacturer? Did I spell it right? Oh, thank God. The day I spell a word wrong on YouTube live, that's when I gotta quit. So you gotta find out who the manufacturer is, who made you, because only they have the ability to tell you who you are. How can you possibly tell who you are, right? Or why you're here? You mean you can say it, right? You can come up with your own answer, but what if you're wrong, right? So we got to figure out who the manufacturer is. Then we start getting into the meat and potatoes. What's my purpose? Okay? What's my purpose? Again, you got to go to the manufacturer for that. When Ford made the car knows that it has to do X, Y, and Z, and it's made with these parts. Well, the manufacturer creates a manual, puts it in the car, so when the user gets in, they could read the manual and they can see, oh, that's how you turn the car on. Okay, when there's an ignition problem, when there's a transmission problem, when I need to change the oil, when I need to change tires, there's a manual, right? Manufacturer. Okay, cool. And that will define the purpose of the product. So I'm a product of my maker. Got to figure that one out. Once you get that down, you'll have the answer to your question. If I was to make a business, right? What would I do and what would I want to, do, whatever it is. And then the final one is, where are you going? Because if you don't know where you're going, right, you could know who you are, you can know why you're here, you can know your purpose and everything, but if you don't have direction for your purpose and why you're here and who you are, I mean, you're useless, man. You're working at a job that just ain't for you. You're in a position that just ain't who you are. You're doing things outside of your comfort zone that don't align with your mission, with your purpose. There are some things that we have to do in life that are uncomfortable, yes, and you have to step out of your comfort zone, yes. But then there are people who get stuck in uncomfortability, or they get stuck in comfort, which becomes uncomfortable because it's so comfortable, and you get confused, right? And I'm confusing myself right now. So where are you going? You got to know where you're going to go in life to answer that question, right? So I hope that helps, my friend. I'm telling you, I could give you the stats. I could say, hey, start a business, start a financial business, start a fitness business, start a branding business or a marketing business. These are the hottest businesses right now. But if that does not align with you, then you are going to be terrible at it, right? Or you're going to be fake, right? You don't want to be fake, right? Or you're going to be so good at it, but then not fulfilled with it. You could be good at something, but not really be fulfilled with it. Like, I know there are some things that I'm good at that don't fulfill me. And then there are things that I'm great at, that it's like, this is me, man. This is where I'm supposed to be all day, every day. I wake up, this gets me excited. I have the drive like no other. So not only am I doing what I'm great at, but I love it and it fulfills me, okay? Because our ambitions can kill us, right? Our ambitions to reach so high that you don't know why you went that high in the first place. So you want to make sure you're on that level. Christian, good morning, Denzel and everyone. Is it a good idea to pay my home taxes from the line of credit instead of chunking it in my mortgage payment? I feel I can chunk my mortgage faster by doing this. Yes, I would agree. In fact, I might do this. Where's my eraser? I might do this. I think I spoke about this on another live stream. I forget. Do so many of these. But let's see. So, for those that have a mortgage, let's say you got a mortgage and there's taxes on that thing, right? You're either paying it quarterly, annually, or monthly in the mortgage payment. You could separate your mortgage principal and interest payment from the escrow. So you could separate the escrow, pay it yourself. That'd be the first move that I would do. And then now you're responsible for paying that quarterly, annually, however you do it. And yes, I would do it in the form of chunking. You pay it, right? But I think what I would do is I would get a credit card at 0%, and then 0% on balance transfers, 0 fee, right? Right, so 0% on balance transfer, no fee for like 12 months. Throw it on a credit card. Maybe you get some points and mileage with that. That'd be super cool. You can do what's called a convenience check. So you write a check to yourself, goes to your checking account, and then you pay the taxes. And then however much that tax bill, that payment is, you pay it at the beginning of the year or at the end. It's money that you already have to pay. It's already coming out of your expenses. You factored it in to your 4 majors. So you already know that that's coming out. All we're doing is prolonging when I pay it. So I could use the bank's money with a credit card, 0% on balance transfers and no fee. You can negotiate that for the first time around, second time around, third time around, right? And then now you've prolonged the payment, so you pushed it out. Let's say it was at the end of the year when it's due. So you have the money for it, but you're just using the credit card first to prolong it for about 12 months, 18 months, 15 months, however long the 0 interest period is. And then that same money that you had, now you can chunk more at the principal mortgage to knock that down. By the time this thing expires, you would have been paying the monthly minimum payment on it at 0%. So all of that monthly minimum payment is principal. The month before it expires, you could get another credit card at 0%, 0 balance transfer, blah, 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 and do it all over again. Or if you don't get one, then you just use your line of credit to pay yourself back and keep it going. Keep it going. And then if you are using a line of credit, be sure to keep increasing the credit limit, the capital, so that you have more chunks, more chunk capability going to the mortgage, so that you are staying ahead of the interest rate each and every time. Hope that helps. Let's see. How can I do velocity banking with 4,500 income, 4,500 expenses? Because I put everything towards my mortgage debt, 225,000. So he's asking a very basic question here, right? What's he asking? He's asking, how do I do velocity banking? Well, first, starts with education, right? Mr. Martinez, got to educate ourselves first. So it starts with education. Watch my videos. Get to know me. Get to know what I'm about. Find a teacher to teach you the concept. I could be a teacher. I am a teacher. This is what I do. Once you find a teacher, you watch my videos or other videos. Then you got to make a decision. Okay, well, who do I go with? Who do I know, like, and trust? And then once you figure that out, then, you make a purchase. You're like, okay, well, I'm going to invest in this concept here because I think just maybe there's another way out there in the world for me to pay off my mortgage faster than just making extra payments. So if there is a way out there, I got to figure out that way and find out who's done it, who's been there, and then I invest with them. So that's how I do velocity banking. From a practical standpoint, we need to figure out your 4 major numbers. So you already wrote 2. You wrote 4,500 income, 4,500 expenses. Well, of those expenses, how much extra are you putting towards the mortgage? We get that number. And then what do we need? We need a debt tool. We need a line of credit, a credit card, a HELOC, or a high cash value life insurance policy, or all 4, right? And then we figure out the concept. We have to learn the concept of velocity bank. We have to take time and money and investment and a teacher, and then you'll get what you want, my friend. Let's see. JP. 50K from line of credit to policy year 1. Pay back line of credit from policy loan year 2. Add expense from negative cash flow. Wash, repeat? Question mark. Is there a better way if trying to fund a policy using the bank's money? Thank you, sir. Okay, it sounds like a bit of a dangerous concept there, right? Let's write it out. Let's figure what the hell JP is trying to say here. What's this man thinking? He's trying to duke the concept. The concept is already duking people, but this guy's trying to like duke it twice. He's like, I'm gonna duke the banks, I'm gonna duke the concept, and I'm just gonna like let's see if it works. So he's saying line of credit, 50K. Maybe the line of credit is higher than 50K. I mean, I think it's unwise if I had a 50K line of credit and I chunked the whole 50K. But let's just say that he does that. So he's saying 50K into a policy, 50K. What needs to happen? 5,000, right? Needs to go towards the premium. Well, let me backtrack. First of all, depending on your age, health, and income, is going to determine whether the insurance company is willing to do this or not. So you have to have the income, the health, and age. You have to have all 3. We all do, right? To get approved for such a number. So the insurance company is going to ask you, well, where is the money coming from, right? So if you don't have existing capital, the amount of income to actually pay that, they're not going to let you do it. They might approve you for 30K, right? And if your health is poor and if your age is older and health is poor, then they really might not do it, okay? So there is a qualification process from the insurance company before they actually take your money. Understand? So that's that. So if we're taking all of this line of credit, because they're gonna see, okay, you make 30 grand a month, you make 30 grand a year, you make 40 grand a year, you make 50 grand a year. How are you possibly going to afford putting in to a policy 100% of your income? It doesn't make sense, right? So that might not work for you. But let's say you are making more money. Now, typically, if you're making more money, most people have capital and assets. So, it wouldn't make sense to actually, borrow all the money. That's why we stick to that number. 66% range gives us a boost. We're not going too crazy, right? But let's say it was able to work. Somehow, company said, yeah, we'll do it. We'll take a risk on you. So you take 50K here. Now we have a debt for 50K. And so basically, we would need the right income, expenses, probably no debt. We need good cash flow to be able to pay back the line of credit. But what he's saying is 50K minus 5K is 45. And then with the OYT expense, right, the 1-year term insurance and the PUA, let's say he's got 43K to work with. And then remember, 43,000, you can only borrow 95% of that money. 43,000 times 90%, say 38,700 to actually borrow from. So let's say he borrows, Marcus dying. Shoot. Let me see something here. So let's say 38,700 he borrows to pay back the policy. To pay back the line of credit. Does that work? Let's see. Let's see if this guy is on to something or he's just, curious. If I take out loan, so cash value and then policy loan. We have a policy loan for 38,700. I have 43,000 in there. Paying 6%, earning 6%. Let's see. 38,700 times 6% is $2,322. So at the end of the year, he'll owe $2,322 plus $38,700. So he'll owe $41,022. Over here, we have 43,000 minus 38,700. So 4,300 of the 43 is earning, say, 5.5%. So 236.50 plus, what was it? 2,322. 2,322 plus 236.50 plus 43,000 in original cash value at the end of year one. Maybe my cash value will be somewhere around that number, $45,558.50. So I might have that amount in the first year, and I'll have this much in policy loans. Okay? On the line of credit, I took out 50K minus 38,700, so I owe 11,300 on the line of credit. So as long as you have the velocity banking to basically pay this 11,300 back in time, right? So you do velocity banking for however long to bring that to zero. And then what was he getting at? And then he said, okay, so he said 50K from the line of credit to policy year one, pay back line of credit from policy loan in the, well, you should have said year one, right? So you put it in and then immediately borrow to pay it back. So that's the first year. Now I'm approaching the end of the year. This could work as long as you don't have really any debt. Yeah. Shouldn't take me that long to pay back 11,300, dumping all my income and expense in the line of credit. Year two, you have to decide, am I going to pay this back, 50K, or do I leave the policy loan outstanding for 41,022 and then just add another 50 in? So let's say he did it again, the year two adds another 50K in. Could that make sense? Let's say in the second year, his cost of insurance would go down a little bit. And once you get past years 1 and 2 of the policy will start to perform a lot better. So you have to get past the initial expense in the beginning years. So let's just say, conservatively, the second year, I do not pay back the 41,022 in policy loans, and I add another 50K to the anniversary date. I add a new 50K in. So 5K goes towards premium, pays the OIT insurance, the 1-year term life, pays my paid up additions, rider fee, and then let's just say I have another exactly 38,700 in there. So 38,700 plus that 45, 58.50. Okay, what did I do? Let me see. 38,700 plus 45,558.50 cents. 84,000. $84,000 to 58.50 is what my new cash value would be for the beginning of year two. And then, since I borrowed another 50, he's saying to now go ahead and borrow whatever I have in cash value. So 84,258.50 minus. Let me see. go like this. Turn this back on. Okay. I think I got it back. I think I got it back. Let me see. I think, damn man, my internet. No, it wasn't my internet, it was my computer. My computer died because I was going ham. Let me see something here. All right, comment if I'm back live. Comment if you see me, I'm good, the camera's good, audio's good, testing 1, 2, 3. It says there's 43 people watching. Okay. I tell you, boy, damn tech. Everything is good. Yeah. Cool. Jeff Brown, Loretta live. Okay, great. Okay. Well then, I think I left off before it cut out, because we're getting into some good data here. Because at first I was like, no, JP, this ain't gonna work. But I'm running the numbers and it would work as long as I guess I don't have any debt, nothing going on, and I'm simply just like, just throwing as much money as I can in there and I'm paying it back, borrowing from it. So to recap, 43,000 was the starting cash value, let's just say, in the beginning, the first year. I borrow 90% of what I have in cash value, 38.7, to dump it back in the line of credit, do velocity banking to bring it to zero. By the anniversary date, I'll go ahead and add another 50 in there, 50K. And then we said 38,700 the second year around, like the same amount. Let's just say starts cash values being conservative. So I have 84,258.50 in total cash value, but $41,022 in policy loans. So what I actually have available to borrow from is $43,236.50. And then I said $43,236.50, take 90% of that is $38,912.85. So I do a second loan for $38,912.85. $38,912.85 to basically pay back the line of credit again. Do velocity banking till you hit zero. Should hit zero fairly quickly. And then you could maybe pay some of the policy loans back. So now you'll have $38,912.85 times, well, let me add it all up, 41,022 plus 38,912.85. So you'll have in the second year 79,934.85 in policy loans times 6%, 4,000 $796.09. 4,796.91 plus 79,934.85. 84,094. So you'll be paying 6%, earning 6% on what you have borrowed out. And then, I don't know, can that work? Am I allowed to have that many policy loans and have it be more than what I have in, let me see, 84,258.50 times 5.5%, 4,634. 4,006. Would that work? 84,258.50 plus 4,634. 89250. I don't know, it's kind of close, man. It's kind of close. So I think, to an extent, it might work. But you would have to be very on it. You'd have to be like really, really on this thing. And I guess the way it works best is you basically max fund the policy using the bank's money, right? And because we then borrow from the policy at the beginning of that year, or at the beginning I start the policy, to stay ahead of the interest that I'll get charged over on the line of credit by knocking that down and having to maybe pay interest for a couple of months. So that interest plus the interest that I'm getting charged versus what I'm earning, it could potentially work, but you know, it's like skating on thin ice. You know, what if, I don't know, you lose your job or you have an emergency? Where's the leg room? 88 and 84. Yes, this number will always be less than that number because whatever you're getting charged in interest, even with the compounding effect, you have to understand that your money is also compounding on all of the money that you initially put in there. So you would stay ahead. You'll start breaking off eventually. You'll start, you know, it'll get higher and higher, the separation from year to year. But then I guess, you know, you fund it for maybe 5 years, 7 years doing it this strategy, and then turn it into reduced paid up, and then just pay yourself back over the years. And then you have a big fat line of credit to work with. So, you know, it could work in a perfect world where there's no issues, you stay healthy, nothing's wrong with you, no emergency, no kids, no family, no, you know what I mean? Like maybe this would work great for single people, but I don't see it working so well for majority of people. And you have to understand this like the way I understand it. So you need to be able to operate this better than how I'm writing it out right now, because there's probably more pieces to the puzzle that I'm probably leaving out. So what's great is even though it canceled the video, it didn't take away the comments, so I can look at everyone's comments. That's perfect. So let me just scroll back up to JP's comment. All right. Let's see, who's got a question? Let's see. Hidden says, how do you determine infinite banking numbers? Can you do video on what calculations you use for creating and what type of policy you would recommend for a client? Yeah, I've done that plenty of times, my friend. You just gotta find the videos. On my manifesto though, I put it in order. So I show you where I put everything. And You can check that out for yourself. But in a nutshell, if I was figuring out, okay, what are the factors when I'm looking at, you know, helping a client design a policy, what am I looking at? What am I looking for? So cash flow times 12. What's your cash flow in a whole year, right? Do you have any capital? Right, we're looking at capital. And then we're also looking at your leverage. Right, what do you got? You got a credit card, you have a line of credit, you have a HELOC to improve the situation. Okay, if like let's say this number's not great, but you do have good leverage and existing capital, then that would supersede your cash flow times 12. Then, you know, great. What is 66% of your line of credit? That's going to determine what my chunk would be if I'm using a line of credit, a HELOC to fund a policy. Maybe I don't have capital. So I'm looking at these three numbers right here. And then what it all boils down to is, you know, your age, health, and income, whatever the insurance company is willing to approve you for. And then we're also looking at purpose. What is the purpose of the infinite banking policy? Are you using the infinite banking concept to just simply save money tax-free and not touch it? Or are you using it to, you know, you want to invest in real estate? Or are we going to use it to pay off debt? So we're looking at the purpose. You know, is it debt, investment, saving? And it could be all three. It could be all three, but we know we would create the steps. So hidden, boom. Here are the three numbers. Cash flow times 12, capital, leverage, 66% of the line of credit. And then I basically put a policy together and I say, here, does it make sense? Do you think you could do this? Yes, no, maybe so. And we put it together. Claudia says, hi Denzel, I have 2 car loans with simple interest and a mortgage with amortized interest. Which is better to start with? Thanks. I am in Manifesto. Manifesto. Cool. Love it. Let's see. If you owe, you know, between 150K, 500K plus on the mortgage, you've got 2 car loans. Yes, it's at simple interest. Great. But it's still technically a loan. So it's money you can't access. It's locked up. It's a set payment. But it's at simple interest, so you are getting charged less interest than it would than a amortized debt. So that's pretty cool. But I'm still most likely going to tackle the smaller debts. I mean, we're doing the same thing with Debt Snowball, guys, and Debt Avalanche. We're trying to knock out all the other crap that's in your way before we get to the mortgage, so that by the time we do get to the mortgage, we have the most amount of cash flow to work with and the most amount of leverage, whether that be a line of credit or a HELOC. So the best credit score, you know. So I like that. Let's see. Asia Woods Livingston. I have a credit card with a 9K balance from a recent investment. I have a line of credit in the amount of 3K. I messed up the system somehow because the credit line is now maxed out too. Can you clarify how to properly rotate funds to eliminate the debt? Yeah. 3K line of credit, and I borrowed to invest money. I think Dave Ramsey would whack you over the head. Be like, why would you borrow money to invest money? And what has that investment gotten you? Did I get a return? How fast is the return? Did you go in blind? Did you not think? Did you, leave the house, and did you get sold into something? So, there's some variables there. Like, what? I invested $9,000 in an investment with debt. I don't know how much I would be willing to do that myself. Being that this whole channel is all about leveraging and borrowing debt, yes, I understand that, but there are careless ways of doing it too, right? So we've got 9K owed on credit, and then 3K line of credit maxed out. So, Asia, what are your 4 major numbers? Income, expense, debt, cash flow. You should be dumping all your income in here. Pay the minimum payment on the credit card. Cash flow stays in. You do velocity banking. Bring the line of credit to 0. And then you chunk 3K at the credit card, and c'est la vie. You are done. Okay? Not that bad. If you're making $2,000-3,000 a month, it might take you a little while. If you're cash flowing a couple $100, might take you a while. Yeah, 6 to 7 months, whatever it is, but that's, that's what you get for investing with debt. Let's see. Claudia says, ready to apply for HELOC. Can I refinance and get a HELOC simultaneously? What could be a good deal? Can I do that, guys? Can I refinance my mortgage and get a HELOC? I don't think so, right? Because when you refinance, you get the cash right then and there. So you lose the equity when you refinance, if I'm not mistaken. So I don't know if I would do that. I would look into it. You get a HELOC. You start off in the second position, and then you eventually work your way into a first position HELOC once you've you knocked out maybe 50% of the debt itself. Let's see. Kimmy K. I'm 60 years old. Can I use my 401k to roll into or buy my whole life policy? Sure you can. Sure you can. In the description below, there's a link. It says ready to acquire your life insurance asset. Click here, and they'll help you out. Let them know my name, Denzel Rodriguez, sent you, and they will gladly help you design that. If you're simply just looking to say, okay, I want to roll it over, a one pay, and then boom. Or roll over whatever you have, and then you say, I want to roll over 100,000 or 200,000, 300,000 as a one pay, and then pay, 50,000 for the next 5 years, or 25,000, or you want to put 100,000 in, so you already know 10K premium, 90-10 split, and then you go from there. Let's see. Billy says, I looked it up and it looks like you can, but it depends on your bank. They won't even charge extra fees when you do both. You just have to have enough equity to get the HELOC, of course. Okay, I guess it could work. But I guess it's also depending on the bank. She has at least 50K equity now. Do you know a good APR for a HELOC? I mean, you've got those intro rates. HELOCs are like 5%, 4%, 6%. I like that range. Let's see. Let's see what we got here. Any other questions? Kind of scrolling through here, guys. Bear with me. Dave says, this is phenomenal. He's probably referring back to that whole thing I did with the scenario. Okay, Caesar, if the car loan was at 0%, is it still better to pay off with a policy loan? I think so. Yeah, I like it because I've done some cases where I have someone that has a lease, like a $500-700 lease payment, and we used a policy loan to wipe that out so that we could have the cash value now. I mean, to have the cash flow of $700-800 payment now to funnel through the line of credit so I can chunk faster at maybe another debt. So that could be an option. So it could be a yes, it could be a no. It really just depends on where your numbers are at. But that is a possibility that, you know, I have done scenarios where someone has a 0 interest debt against a much higher debt, and either option one, we do a small chunk towards the higher debt until the 0% expires, or if it's just a 0% debt that doesn't expire, it's just 0%, depending on the cash flow gain, I might tackle that first so that I can tackle the bigger debt with the higher interest a little faster. So we'll see. Dave says, I'm doing Velocity Banking now. I'm forever a Patreon supporter of yours. Love it. Thank you. Appreciate that. I've started Velocity Banking and in 1 month paid off $5,500 in debt. I'm not as versed on the insurance side, but this is great info. Good topic, Denzel, from Rich. This is what I'm basically doing so far. 60K paid off, 30K policy, boom. If this gentleman was pulling from the policy in retirement, that would bring down his death benefit. Yeah, but we don't really care about that because he has a 10x mindset. So when we're doing infinite banking, I know a lot of people sell the infinite banking in a way that you basically fund it for a couple years and then take lifetime income. I don't really care for that. I rather keep using the thing to create more and more wealth and more wealth and just never stop and just keep going with it. Wesley, how do you know how much to start infinite banking? I already said it. Age, health, income, cash flow times 12, 66%, and capital. Let's see. Loretta Lewis says, how about showing how to convert an amortized loan to simple interest? I meant the actual interest paid on an amortized loan compared to a simple interest product. Example, I borrow 100K to buy a house at 6%, but to make all the payments, I've paid over 200K. My math says that's not 6%. Yeah, you're right. You are right. 6% on an amortized loan is not really 6%. It's more like 600%, 60%. It's ridiculous, right? So I'm telling you guys, when you guys really learn that whole Simple versus amortized. Oh my goodness, what an awakening that is. Chicago says we share the same birthday. Happy belated birthday. Thank you, sir. And then happy birthday to you. I also want to say thank you to everyone that wished me a happy birthday, sent me a gift. I really appreciate it. Love you guys. That's awesome. People sending me gifts and Amazon gift cards from, oh my God, that's so cool. Love it. Really appreciate that. Let's see. Hidden, I use your examples, draw it out, and try to figure it out, then play your video and see where we close, where we are, whether we're close, off, or so I can truly grasp it. Keep you in prayer, because what you do is a million blessings. Appreciate that, man. Appreciate that. Right. Jasper, wow, over 2 hours. Yeah, man, I'm going hard, man. Like, trying to help these people out. It's 2020. It's 2020, guys. Okay? Here's the strategy for 2020. I'm gonna do something stupid. This is my plan to hit 3 million in revenue. Let me know if I'm on to something or not. It is 2020, and I am just, that's it, I'm giving. I basically want to give in monetary value what I made last year in revenue, right? And then, following the whole kingdom principle, you give and you receive, and I adopt my kingdom authority, create 3 million in revenue so I can help even more people at affordable prices. Because when you look at the industry, the price of coaching for velocity banking is anywhere from $3,000 to as high as $10,000. And that's not lifetime. That's, maybe 1 year, 10 phone calls, maybe 5 phone calls. It comes with a Facebook community and da-da-da. Talk to people, right? Facebook community, and get to email questions. All right, get to email questions and Facebook community. Couple calls. They give you a cool spreadsheet to fill out and say, here's your one and only spreadsheet you'll ever need, and here's a calculator. It'll show you exactly what to do, when to do it, and all that good stuff. It's great, but majority of people just do not know how to make sense of spending $3,000 on themselves. They'll spend $3,000 in Christmas gifts. They'll spend $3,000 on a vacation. They'll spend $3,000 on other people and other experiences. But when it comes to investing in yourself, this just seems impossible, right? So you got to get past that. So I'm like, you know what? All right. What if I just brought velocity banking at such affordable prices that it was just ridiculous, like ridiculous. So I created my manifesto, right? The Velocity Banking Manifesto. And by the way, because I didn't launch the program yet, I'm still offering it lifetime access. So anyone that signs up, I've had some people that sign up that probably think they're getting it for just 1 year. By the way, you're getting it for your whole life. Okay, so right now it's $70 for your whole life. And it's videos, it's live streams, it's Q&A, it's community, it's just consistency. That's all it is. It's just consistency in the numbers, in the fundamentals, running your numbers over and over again, making sure you get this thing, because I want to teach you it so you do it. That's the way I teach my clients, is It's like I'm doing it, but you're doing it with me. And I'm not telling you all, just tell you, like I'm showing you how to do it. I'm describing it to you. I'm breaking it down little by little so you get it. So I was thinking this, right? But for 2020, as soon as I get my platform up and running, you guys are gonna love this, okay? I'm gonna offer it for $14.99, like a Netflix subscription. $14.99 a month, right? Or you pay it annually, you save money, just like you would an Amazon Prime membership, or just like any other membership that you would buy. If you pay it by the year, you save money. You pay it by the month, you pay a little more, whatever. But this, so change your life, literally. And I'm gonna have lessons on velocity banking, infinite banking, kingdom authority, creating wealth, talk about real estate, talk about saving money, storing money. I even want to get into like Forex a little bit. So that's my goal, to hit 3 million. So I figured, okay, well, how many people do I need to talk to get to 3 million? 3 million divided by 14.99 is 200,133 and 42, but you divide that by 12, you figure they pay for the whole 12 months, that's 16,000 people, right? So if I did 14.99 times 10,000 subscriptions, that's 149,900 a month, times that by 12, that's 1.79 million. So I would need anywhere between 10 and 15,000. Let me do 15,000. 14.99 times 15,000 people. So I help 15,000 people this year sign up for the manifesto at $14.99 a month. That's $224,850 a month in revenue times 12. That's $2.698 million, $200. Very close to the 3 million. The other 400,000 or less can come from one-on-one coaching and my master classes and life insurance policies, and then referral marketing and network marketing. Boom. So if I do that, oh my, going crazy. All right, we're gonna do some more questions. Javier, for those who have FHA mortgages where we have PMI for the life of the loan, does it make sense to refinance to get rid of the PMI? I still owe 25 years on the loan. I would refinance down, not up, to get rid of PMI if I have the ability to do that, Like, because I had a client that went from a 40-year mortgage down to like a 15. That's super, super fast. I would do that, totally. Refinance down, not up, Let's see. Any other questions, guys? I think that's everything. I think everybody is like, all right, Denzel, this is a lot. So that's my plan for 2020. 3 million in revenue. What's your plan? I want to hear it. Comment below. What's your financial plan? What is your attitude going into this year? Are you going into 2020 with 2019's attitude, lack of belief, lack of faith? Or are you just going to amp up your game? What are you going to do to get completely out of debt? Are you going to 10x your income? Are you going to build your wealth? Are you going to get serious and put on the big boy pants, right? And get to work and do this for your family. By the way, February 20th to the 23rd, I will be in Las Vegas for the 10X Growth Con number 4. So if you are a Las Vegas resident, okay, you live over there or anywhere in the neighboring states, and you'd like to meet me in person, I will be in Las Vegas February 20th to the 23rd. If I have any, I know I have some clients in Las Vegas, so just letting you know now. I'll send an email out to all those that are on my email list, just letting you know where I'll be. I do plan on doing some speaking engagements across the United States this year, so we'll see how that goes. We'll see how that goes. And then we'll talk and we'll hang out. I'm a very simple person. I love to eat a nice meal, enjoy some conversation, experience the outdoors, and that's it. So I don't think there's any other questions. I think this has been a very productive class. All right, I want to wish you all a wonderful day. God bless, and talk to you soon, okay? God bless.